Welcome to The Explainer. So, you know that feeling when you're in a group chat and everyone suddenly starts oversharing at the exact same time and it's just pure chaos? Well, today's financial news felt exactly like that. We had major players in the fintech space making these massive, multi-billion-dollar moves, all demanding the spotlight at once. I mean, playing coy in business is definitely a strategy, but today we saw three massive companies exuding absolute main character energy. The spotlight completely fell on three major companies today: PayPal, Chime, and Zions Bank Corporation. And what's really fascinating here is that they didn't just make headlines. They executed three wildly different financial strategies on the exact same day. One decided to play a fierce game of defense, one went completely on the offensive, and the third proved that sometimes the ultimate financial flex is just having a whole lot of patience. So, that brings us to the big question. What actually happens when three financial giants decide to overshare on the exact same day? And more importantly, how do these massive corporate chess moves actually impact you? Because make no mistake, this isn't just boardroom drama. These are strategic maneuvers aimed directly at the apps on your phone and the money in your wallet. Okay, let's dive into this. 1. PayPal plays hard to get. 2. Chime sneaks in Wall Street. And 3. Zions cashes a vintage ticket.
Starting with number 1, PayPal plays hard to get. The art of playing defense.
$53 billion. That is the massive takeover bid that Stripe and Advent International just slapped on the table. They offered $60.50 per share, and they backed it with roughly $50 billion in committed financing from Wall Street heavyweights like JP Morgan and Morgan Stanley. This wasn't some casual inquiry, right? This was real money. And PayPal's board formally looked at this absolute mountain of cash and said a very real, very firm no. So why on earth do you walk away from that? Well, under CEO Enrique Lores, the turnaround executive they brought in to speed things up, PayPal firmly believes their best chapters are completely unwritten. They feel a bit like your fantasy football team after a 1-3 start that you absolutely swear is just a rough patch. And honestly, they've got the numbers to back up that confidence. Venmo now boasts 100 million users. 67 million of them are active every month. Plus, their overall revenue was up 20% last quarter. That just isn't a business begging to be rescued.
The contrast here is pretty wild. That rejected bid, it carried a 28% premium to PayPal's pre-news stock price. That's a guaranteed, instant, incredibly lucrative payout. But PayPal's board weighed that immediate 28% bump against their unwritten future value, and they decided the offer just fundamentally undersells what the company is actually worth. They're choosing the rocky road of independence because they believe the long-term destination is just way more valuable.
And look, the stakes go way beyond today's share price. This is a full-blown stablecoin real estate war. Stripe already owns Bridge, which is their big stablecoin infrastructure play. Meanwhile, PayPal is running its own PYUSD. Whoever controls both sits on incredibly valuable real estate in this whole emerging economy of programmable money. And the race is heating up fast. Visa is even rolling out its own institutional platform, treating this tech as core payments infrastructure. Everyone just desperately wants to control the plumbing of the future of money.
So, the crucial point for our first story is this. PayPal isn't necessarily saying no forever. They're basically just looking at the offer and saying, make it make sense. They demand an offer that actually respects their potential and their strategic position in the payments landscape. The ball is totally in Stripe's court now, and their next move is going to tell us exactly how badly they want to own this space. Moving on to Section 2, Chime sneaks in Wall Street, playing offense by completely removing friction. Get this, while 60% of Americans own stock, a massive 40% do not own a single share. That is a huge chunk of the population entirely left out of the market. And Chime's core pitch here is that this 40% isn't sitting on the sidelines because they aren't interested. They're sitting out because of friction. It's just too complicated, it's intimidating, or it requires opening too many separate, annoying accounts. Enter Chime Invest, which literally launched today. This new feature lets members buy stocks and ETFs right inside the exact same app they already use every single day to check their balance or split rent. They aren't asking you to download a new, intimidating trading platform. They're basically just bringing the trading floor directly to your digital wallet. It's honestly a brilliant playbook. Step 1, remove the usual banking friction. They built incredible loyalty early on by offering no overdrafts and early paychecks. Step 2, fold seamless investing directly into that daily checking app. And step 3, compete with Robinhood and SoFi for that ultimate one-app crown to run your entire financial life. Why this matters is simple, but it's super profound.
Chime isn't trying to disrupt Wall Street with some flashy new tool. They're sneaking Wall Street into an app you already open instinctively. Think about it. You didn't make a conscious decision to become a Venmo user one day. You just started using it because it was ridiculously easy. Chime is betting that if they make trading as easy as checking your balance, everyday checking behavior naturally becomes investing behavior.
All right, Section 3, Zion's caches a vintage ticket. The ultimate game of patience.
This is what completely crushing your quarter looks like. Zion's just posted Q2 net earnings of $452 million. That is nearly double the $243 million they posted a year ago. Earnings per share totally skyrocketed from $1.63 up to $3.05. It's a massive, eye-popping beat that had Wall Street doing a double take. But the real story is where a big chunk of that cash actually came from.
That headline earnings number got a serious assist from a $215 million pre-tax gain. And how do they pull that off? By selling Visa Class B1 shares. The source material described this perfectly. It's literally the fintech equivalent of finding a dusty stock certificate in your grandpa's attic and realizing it's worth an absolute fortune. This wasn't some high-frequency trading algorithm. This was an incredibly old asset just sitting quietly on the balance sheet.
This legacy stake goes all the way back to Visa's 2007 IPO restructuring. 19 years ago, the original stake was secured. They literally sat on it through the 2008 financial crisis, through a decade of tech booms, through a global pandemic, all the way to Q2 of today where they finally cashed it out. 19 years of patience resulting in a $215 million payday. Unbelievable.
But here is the real unsung hero of the Zion story. $1.74. If you completely strip out that massive one-time Visa windfall, their core business still earned $1.74 per share. That actually put them ahead of Wall Street's expectations heading into the print anyway. So beneath that shiny lottery ticket, Zion's is doing real, solid work in commercial lending across the western U.S., adding another strong data point to a regional banking sector that's having a genuinely solid earnings season.
So the key takeaway here, a vintage 2-decade-old stake definitely makes the headline numbers look amazing, but the underlying core business still secured a genuine beat. Patience absolutely paid off in the millions, but steady, boring, traditional banking is what keeps the lights on and keeps Wall Street happy.
Section 4. The big takeaways. 3 companies, 3 very different strategies.
Just to quickly recap today's fintech group chat. On defense, we've got PayPal. They're holding out for a much higher valuation, fiercely protecting their territory in these looming stablecoin wars. On offense, we have Chime, betting that the best way to get you to invest isn't a brand new app, but by turning your everyday checking routine into a trading floor. And playing the long game with extreme patience, we have Zion's, riding a 19-year-old Visa bet to completely crush their quarterly earnings.
At the end of the day, whether they're fighting over programmable money, killing banking friction, or cashing in legacy investments, all of these multi-billion-dollar corporate chess moves really boil down to one thing: the ultimate battle for your daily financial loyalty. They want to be the infrastructure, the interface, and the institution that you trust with your money. So, I'm going to leave you with this to think about: defense, offense, or patience. As these financial giants keep iterating and pushing into totally new territories, which of these strategies is actually going to win the battle for your wallet? Will you stick with the established players holding their ground, or is the app that makes everything perfectly seamless going to win you over? Thanks so much for joining me on The Explainer today, and keep a close eye on your own financial group chats.